I think the move in rates is driven by a strong economy, the Fed continuing down the tightening path. I think that comes off middle of next year or first half of next year as the economy moderates and the Fed starts to find ways of getting off of its tightening path. So it's to be expected that at some point the U.S. economy is slowing and rate pressures come off and the markets stabilize.
All right. Kim, what do you think? Do you agree with Krishna's point of view there that maybe the rise in interest rates will slow by the middle of next year and that the market can keep rising apace?
Well, I think it all depends on how well the economy's doing and if the Fed feels it's overheating. If things remain as they are right now, and that's with pretty good job growth, pretty good but not super hot job or income growth, and then, okay inflation, which is around 2%, I could see this going on, just as the Fed chairman said, for a long while. But if anything heats up, I think the Fed's going to feel free to raise those rates, and that might bring the party to a crashing end.
And Bill Smead, let me bring you into the conversation. I saw that one of the areas that you like in the face of these rising interest rates is the much unloved home builders. Explain why and which ones.
Well, first to answer your question directly, the demographic momentum. If you look at Diana's reports, she's telling you that things are really going bad in New York City, San Francisco, Seattle, the hot, expensive markets. And that's not where the homes are being built by the 5 largest home builders. They're being built in the other 85% of the country, which Steve Case calls the rise of the rest. So all you have to do is go back and look at all U.S. recorded history. People are most excited to buy a house not when they're the most affordable. That was 2011. We built 320,000 houses. They were least affordable in 1978, and we built 1.4 million houses. Why? Because the baby boomers were getting married and having kids, and now their children are getting married and having kids. The second thing I'll say about the way the market's behaving is as the riskless rate rises, the riskiest investments are going to come into question. And what you've seen in the last few days is what's going to happen when people stop to consider at higher interest rates the bets they've made, the speculation they've been making in the riskiest stocks.
Krishna, it's Dominic here. Are we going way too overboard right now with regard to the rate rise fear? I only say it because the New York Federal Reserve, in its nowcast model just today, took down its estimates for current quarter GDP as well as fourth quarter GDP as well. So maybe things aren't overheating as much, right, Krishna, or not?
Oh, absolutely. I think the U.S. economy has already started moderating. It's growing at a decent pace, but the second derivative is already negative, and I think that continues. So I expect rates to start moderating very quickly and probably go lower by the middle of next year. This is one of the most attractive entry points for long rates that we have come across in a while.
And Kim, you also think that some of the volatility that we're seeing in the market has to do with deals that haven't been made. Tell me about your theory.
Sure. So the third quarter is always kind of weird, and it's weird because people go on vacation, and that kind of makes the sales flow kind of seize up, we'll just say, because people that can sign off on a large deal for tech or for an industrial company, they're on vacation. So that makes third quarter a very uncertain quarter. And I've learned in my 19 years doing this to kind of look past that and try to discern, is this the beginning of a downturn for a company where deals aren't signed, or is it really just a few deals that have slipped because, a lot of the population is out there enjoying the summer? So that's always the head scratcher, but that's what you really have to discern in this next quarter of earnings is, are things okay, or is this just the beginning of, a down cycle? And I have to agree with Krishna that I agree that things are really firing on all cylinders and they are very smooth. And my first segment was really kind of negative, and I'm not negative at all.
Bill Smead, the last word goes to you. Tie it all off. What's your best advice for our viewers today?
The advice to viewers is when extremely expensive stocks start getting hammered, it takes a lot lower prices to actually create value. And the second thing is, do not underestimate the 5-year view. Right now, people are worried about the next 3 months or 6 months. And what you should be doing is betting on Main Street, betting on earnings growth from Main Street, and get away from all the fantasies about what your next virtual reality project's going to be.